Something happened last week that should have been front-page news, and it basically wasn't. The United States government started buying its own bonds back, not the central bank. The Treasury, the same institution that issues the debt, is now, on the other side of that same market, bidding for it. And the reaction from almost everyone who noticed was a shrug. It's plumbing. It's technical, move along. That reading came straight from the top, and honestly, it's a good argument. The Treasury Secretary framed it as a liquidity measure. Long-dated bonds get thin in August. Corporate borrowers compete for the same money. Buying a few back keeps trading orderly. Nothing sinister, just maintenance. Okay, so what actually is a bond buyback? Here's the whole thing in plain words. When the government wants money, it sells you a bond. A promise to pay you back on a date with interest. Short bonds pay you back soon. Long bonds, 10, 20, 30 years out, pay you back much later. In a buyback, the Treasury goes into the market and repurchases some of those long bonds early. But here's the part that gets skipped every single time. It does not pay them off with new money. It funds the purchase largely by issuing shorter paper instead, so the debt doesn't shrink. The clock on it does. Long bonds leave the market, short bills go in, nothing is retired, the shape is just rearranged. I'll put a number on it. On the 19th of August, the Treasury doubled the size of these operations, from $2 billion each to at least $4 billion starting the 9th of September. $4 billion, which sounds enormous right up until you put it next to the thing it's aimed at. United States public debt just crossed $40 trillion for the first time in history. $4 billion against $40 trillion is 1/100th of 1% per operation. One strategist put it about as bluntly as you can. This is debt reshuffling, not debt reduction. Except, and this is where the plumbing story starts to crack, this wasn't one operation. It was the third move in the same direction inside 4 weeks. First, an intervention in the currency market. Then the buybacks doubled. Then, the very next day, the secretary went on the record to say the operations could go bigger than $4 billion. And 4 days after that, reporting surfaced that the money could come out of the Treasury's own cash account, an account holding close to $1 trillion. Now be careful here, because this is exactly the kind of number that gets distorted online. That is a reported possible funding source. It is not an announced buyback size. Nobody has said they're going to spend $1 trillion. But you don't go looking for that kind of firepower over a plumbing problem. Oh, did it work? Here's the scoreboard. The 30-year Treasury yield had just hit a 19-year high. On the announcement, it fell 9 basis points, 0.09 of 1%. And today, after all 3 moves, it sits near 5.16%, barely off that 19-year high. The 10-year eased to about 4.65%, down from a 20-month high. Real, but small. And that's the thing about a fight. You can see who's winning by whether the price moves when the big player walks in. 3 times the Treasury walked in. 3 times the long end mostly shrugged. Here's why that matters far more than the size of any single operation. Setting the shape of the yield curve is not normally the Treasury's job. That's the central bank's territory. Rates, duration, the long end. The Treasury's job is to borrow, at whatever price the market gives it. When the borrower starts managing the price of its own borrowing, the line between fiscal policy and monetary policy stops existing. Economists have a name for that condition, and it is not a compliment. And to be completely clear, the Federal Reserve is not doing this. That is the entire point. The fiscal side is doing it alone. Now the part that made me want to make this video, because if you only watch the bond, you conclude nothing happened. Look literally anywhere else. Gold is sitting near $4,630 an ounce after touching above $4,700 this morning. Bitcoin briefly printed above $80,000 for the first time since May. Neither of those is a growth trade. Nobody buys gold because they're excited about earnings. Both of those are the same bet wearing different clothes. A bet that a fiscal arithmetic problem eventually gets solved through the denominator, through the currency, not through spending cuts and not through taxes. And then there's the kicker, which landed this morning. July inflation came in at 3.7% year over year, unchanged from June, and hotter than the 3.6% that economists expected. That is the 65th consecutive month above the Federal Reserve's 2% target. 65 months, more than 5 years. Second quarter growth was 1.5%. And underneath both of those, the number almost nobody quoted. Inflation-adjusted consumer spending was flat in July against a gain of 0.4% in June. Not collapsed. Stopped. So the Treasury is trying to push long rates down into sticky inflation, soft growth, and a consumer who just quit spending. Every exit from that room is uncomfortable. Now the honest part, because a story this clean deserves to be attacked. 4 ways this read could be wrong. 1. Buybacks are genuinely ordinary. The Treasury has been running them since 2024, and the stated rationale, thin summer liquidity and heavy corporate issuance, is completely plausible and completely boring. 2. $4 billion is small by design. Reading a regime change into a small, scheduled operation might just be reading far too much into it. 3. Gold and Bitcoin have a lot of drivers. Rates, the dollar, fund flows, and in Bitcoin's case, a genuine short squeeze. Pinning their moves on one Treasury operation is exactly the kind of single-cause story this channel is supposed to distrust. And 4. The 30-year did fall 9 basis points on the announcement. Saying it didn't work overstates a real, if small, effect. Hold all 4 of those. They are the strongest case against everything I just said. Here's the read, and then 2 calls you can grade me on. The read. The case for hard assets right now isn't a bet that policy fails. It's a bet that policy continues exactly as it is. Nobody has to be wrong. Nobody has to panic. The deficits just have to keep running, while the authority that finances them keeps stepping in to manage the price. That's a much lower bar than a crisis, and it's why this trade is durable. It's also exactly why it's getting crowded. Now the calls, both dated today. First, the Treasury will not stop at $4 billion. By the 31st of December, either a single operation exceeds $4 billion or the announced maximum gets raised. Second, the 30-year yield is still above 4.75% on the 31st of October, after roughly 2 months of doubled operations. If I'm wrong on either, I'll say so on the day. The first real test is the 9th of September. And policy can't move the thing it's aiming at, but moves everything around it. That's not a failed policy. That's a policy whose real effect is somewhere other than where it's pointed. Research and education only, never personalized advice, and every number here is sourced in today's written issue. There's also a full daily brief covering the rest of the tape. I'm Frankie, the asymmetric signal. One contrarian read a day. Subscribe.